The first Equal Credit Opportunities Fund was launched in September of 2020 and went live on the major RIA clearing platforms in March of 2021 with roughly $40 million in AUM. Over the next 18 months, we grew the fund to over $500 million in AUM, and all of those assets were raised in the RIA channel. The objective of the fund is to provide the retail investor an institutional platform in both private and opportunistic credit. We launched the fund in an interval fund structure, which provides the client the ability to have a daily purchase, a daily NAV, monthly distributions, and liquidity up to 5% of the shares outstanding. It also has no AI or QP requirements, which makes it a very scalable solution for the financial advisor. When you look at our early success, a lot of it can be contributed to the fact that we focused on education. We've conducted over 500 specialist calls year to date with our alternative specialist team, our portfolio team, and individual RIAs. We're also producing a monthly video around the alternative credit markets that is not product specific, that goes out to a few thousand RIAs each month. We're putting out quarterly webinars, and they're focused on an array of topics in the alternative credit space and have been very well received. In addition, we put out a monthly commentary that focuses on our product and goes in depth on what's happening inside the portfolio. We're really excited about the success that we've had thus far in growing our interval fund to over $500 million, and we're really looking forward to 2023.
The fund was set up to invest in two of the primary alternative credit assets, the first being private credit or direct lending, the second being public credit, which is primarily broadly syndicated bank loans and high yield. Those characteristics of these securities, senior secured, floating rate, tend to be very attractive for a portfolio right now. As of September 30th, the portfolio was about 38% in private credit and about 58% in public credit, with the remaining 5% in cash. We use that for liquidity purposes. I think the portfolio is set up to perform right now because it's taking advantage of the broader opportunities the public markets are providing. The public market is repriced in response to recessionary concerns and broader economic volatility, whereas the private market right now has been very stable. So we've been allocating our assets in that direction. Over time, however, we'll allocate more to our traditional 50-50 approach. For this current economic environment, which we're heading towards a potential recession and higher interest rates, the portfolio is positioned pretty well to take advantage of that situation. It's primarily senior secured, first lien, so it's at the top of the capital stack, but it's also floating rate, which means in an environment of higher rates, we're seeing higher income being generated in the portfolio. The last thing, and maybe the most important thing, is we are a sector-oriented investor, and right now we are focusing on those sectors that we think will do the best in this specific environment.